All right, there's the record button. All right, we're good to go. All right, hey, it is 7:30 on Wednesday, so let's roll through the markets. There's a lot to cover, so I'm going to move really, really quick. If you're this is the first time that you've listened to this, we're going to be here 20 minutes. We're going to cover a lot of ground. We're going to start with a few minutes on the fundamentals, what's happening in the marketplace, and then we're going to jump straight to the technicals so we can see how they're digesting the fundamentals. The top headlines, and I'm not going to spend a lot of time on this. You guys all know them. It's the virus. There's logistical implications because a huge portion of the world is on lockdown. That's causing freight issues, production issues, supply line issues, causing lots of problems all over the world, particularly in South America, which could just be starting. Um, Oil is got to be front and center. It's a big deal. We're going to talk a little bit about cattle here in just a minute. And then, ironically, here we are on the end of March, and the last thing we're going to mention are planting intentions and weather, moving into planting the bulk of the world's food supply, and it's number 5 on the list because it's not even really moving stuff. So let's take a minute and talk about cattle. I really want to focus on corn because corn is getting. We already knew about a supply shock, right? We knew that we're going to have big acreage, and if you put in trendline yield, you knew we had huge supply. Now corn is getting demand shocks, and demand shocks are coming from both ethanol and potentially cattle. Now, if you've been to the grocery store lately, you've seen barren shelves, right? You've seen no meat supply. My wife just texted me a little bit ago. She said that her Dillon's order, where she ordered on Sunday and is set for pickup today, they couldn't supply any meat or cheese or bread for her order. So it's logical to think, oh my God, that means that there's huge demand for beef. And I want to caution there because that's not necessarily the case. It could be, but let's take a minute and look at the meat market. So if you and I'm going to put up a I'm real quick. I'm going to put up a chart of the feeder cattle here. All right. So here's feeder cattle. This is May feeders, and this is in January. So as we look at January, we peaked out and we had started a topping process all the way back in November in feeder cattle. Now, all of you know I don't trade cattle, but this is really important because we didn't know much about coronavirus until in this area here, and it didn't become a crisis until this area. So what has happened is the food supply is available, but we are having to shift production lines away from the restaurant business and over to the grocery business. And I guess as you understand that industry, that's different cuts of meat. There's a different process to cut those animals up. So our grocery supply just got shocked because everyone rushed to the store and they quit going to restaurants. So instead of jumping to the conclusion that that's bullish beef, I would argue that that's actually very bearish beef and for beef demand because as in order to sustain those higher prices, people had maximum income. Their income was high and they were spending at a very, very high level with the euphoria of a stock market that was rallying and into all-time highs. As people's financial situation contracts and we lose jobs, um, in millions upon millions of jobs across the country because of this virus, as that happens, people are going to contract their spending, and they're not going to spend on the highest value of meat protein that they can buy. We're going to go back to Chef Boyardee and other stuff, and it takes fewer cattle. So longer term, this is actually bearish cattle demand, not bullish. So why is that so important? It's because we're rallying here just a little bit, but if you have bearish cattle, and you have ethanol in an absolute just a horrible situation for ethanol, then you really get a 1-2 demand shock to the corn supply, to the corn market, that's not factored in yet into this thing. So the fundamentals are setting up to be absolutely horrific for corn. Now, I don't want to scare anybody because we have such an accommodative government right now. I mean, we're throwing trillions of dollars at every industry. To think that ag won't get more money is, I mean, of course we're going to get more money. So, but as we sit today, the fundamentals are absolutely horrific for the corn market. The government's got to step in and fix that, or we're going to trade lower. So let's take a look at that from the context of ethanol. Okay, did a lot of work on the ethanol margin, and the question is, with oil trading at 25, where does corn need to be to make ethanol viable? So to put it in perspective, okay, on January 8th, oil traded at 65 bucks a barrel. Today we're trading at 25. 13 days ago was the Russia-Saudi Arabia supply shock that hit the oil market for 25% overnight. That was just 13 days ago. We've had 13 days to start to digest this information, and the ethanol industry hasn't digested it yet either. We're starting to hear rumors of ethanol plants pulling their bids, refusing to take cash corn, and defaulting on payment contracts. So what that means is they're not profitable. So here is a matrix. FC Stone is the genesis behind all these numbers, but I wanted to show you what the ethanol margin does at different corn points or different price points of corn, okay? So here's 350, here's 375, here's 325. Here's the assumptions that I used for DDGs and ethanol, and here's what the margin is. So 375 corn is a hard no. 350 corn loses 8 cents a gallon, and 325, maybe you can squeak out a small profit. But there's one critical assumption in here that I think everyone needs to be aware of, is that these may or may not be realistic numbers, because this assumes that the freight obligation of moving distillers and ethanol to destination is on the buyer, not on the ethanol plant. And y'all know how this works. This is one of the most fun parts of our business. When you sell a commodity, you either sell it FOB or you sell it delivered, right? And the question is who owns the freight? Who's got the transport risk? Who's got the freight cost? And in these bigger businesses, in general, they're going to buy their corn delivered, and they're going to sell their products delivered, which means that they're going to bear the cost of the freight. And if you put freight in, just using some rough numbers of 25 bucks a ton and 3,500 a car to California, this number becomes a 60 or mid 50, and this becomes about 100. That drops that margin at 325 corn to negative 30 cents a gallon of ethanol. You have to drop corn at those numbers to 260 in order to get that to a break even. So let me put this in perspective from a math standpoint, right? Last year, if you remember May, June, with the whole weather debacle and the flooding and all the stuff, right? Corn was so cheap relative to prevent plant insurance, it made a crystal clear case that it would pay you to take prevent plant and not plant your corn. The market recognized that math disparity and said, corn's got to go. So corn immediately reset its value and rallied to that point. And once it got to that point, it stopped rallying and the rally was done. Now, none of us saw that, but in hindsight, that's what it did, right? We were buying into the bullish cases. This math on ethanol is far more compelling and obvious than that math was a year ago. So either oil's got to go up or corn's got to come down. There's no other way to look at it. So with that, let's go to the corn market and let's look at what it's doing, okay? Let's spend some time here. First of all, here's May corn. Here's what we did. Here's this sideways wedge pattern that we traced for months, right? Now, I want to do the math with you. This is the peak at 414. This is the trough, which is 374. That math is 41 cents a bushel. When we broke this line, we can count 41 cents a bushel, which counts down to 333. The absolute low here was 332 before we found support and bounced. So the market traded this wedge pattern perfectly, almost to the penny. And since then, we've rallied just a little bit. And remember, this is day 13 of digesting these new fundamentals, right? And we have huge stimulus coming in. We've got a lot of stuff. We can rally all the way back to the bottom of this hedge line, up at 375 in May or about 390 in Dece. We can rally all the way back and still be in a downtrend in corn. Everything about this market is telling us at the present moment that this is a counter trend rally that needs to be sold. So if we take nothing out of this price action that we have today, it is hedge, 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 because the catalyst is present for corn to drop $1 from where we are. And it can do it really fast if it decides that it needs to do that. Now, all of that is subject to change on the whim of the policymakers, right? So if we go limit up today or next week because Trump says, hey, nope, the price of ethanol is $1.50, right? Period. Executive mandate, $1.50 is the floor for ethanol. Then corn's moving higher because it can justify it. But short of oil doubling or some sort of government intervention, this is set up to be a train wreck. So I want to be very clear about that and make sure people are hedging. Now, you have crop insurance that is valid, and that is hedging, depending on what level you bought, 50 to 80% of your APH. What you need to buy hedges on is the distance from that 80% of your APH to what you think you're actually going to grow. So I want to be very, very clear. You should not go out and just hedge everything in puts. I would make sure that you recognize your crop insurance serves a purpose and it's valid and it's going to be there. You also could get an ARC payment or a PLC payment depending on how far we drop. So what we want to do is buy puts on what's unprotected. So if you think you're going to go 220 and your APH is 200 and you bought 80%, you've got 160 bushels hedged. You need to buy puts on 60 bushel an acre if you want to be fully hedged. That's kind of how the math works. And I hope to all goodness that I'm dead wrong and that we turn around and rally. But nothing about this technical setup is super bullish. This is telling us we're in a counter trend rally and that we're looking for an opportunity to be selling it. So now that doesn't mean we can't work higher and things can't change, but that's the best reading for today. Now, what could change that are beans. Beans have a very different scenario. So now, after beating the bearish horse to death on corn, let me talk about what could be bullish. Soybeans already had a supply reduction coming, right? We were using current pre-phase 1 numbers. We were already shrinking our balance sheet in soybeans. We have acres shifting back to corn. Our yields just aren't as prolific as corn's are, so we already had a contraction. If China steps in and buys all of its phase 1 commitment, we have a further contraction in that balance sheet. What's happening now with the virus in South America is truly interesting, because if they have not taken, and I'm talking broadly in South America, they have not taken the the measures that the rest of the world has taken to quarantine and try to flatten that curve of that virus. So what's happening is they're getting into logistical issues on the interior of South America. So it's not necessarily the ports that are shutting down, but it's the transportation of their beans and corn from the interior out. So if they continue to run into issues in the next 30 days and they don't flatten that curve, and the world has to come here for to meet its bean demand, and on top of this, China is coming out of its doldrum and its demand is becoming more evident. So you've got China in the market for beans, and we've got South America coming out of the market. That puts a push on our front month beans. So we've seen over the last 13 days beans react very, very negatively to the oil news, and now we've kind of taken it back, and we are exactly where beans were 13 days ago. How ironic is that, right? We've rushed to the downside, and we've put ourselves right back to where we are. We filled our gap, so that's no longer counting to $8. We filled our gap, and we're looking higher. If we can climb above this $9 mark, and if the world comes here to buy beans in a prolific manner, I don't know what number goes in front of beans, but I don't think it's a 9. So beans could get really hot, and that could support corn as well. So we've got this huge dynamic that has that is out there. I mean, you can't be more bearish corn than what the fundamentals are. And honestly, beans are set up to be really good. So the market's got a lot of homework to do here over the next 30 days as it decides how many acres it needs in what. I feel like I beat that to death. Let's look at new crop beans because they haven't quite rallied as much as old crop. So here's the gap on new crop beans. Remember, in May, we've already closed it, right? In November, we have not. We're still 25 cents away. It's not out of the question that beans go ahead and just go close that gap and call it good, and kind of reset their values too. So, and then one last thing to show you on beans here. This is a big deal as well. When we broke last week on beans, this is the monthly chart. When we broke some major support levels that have held beans since 2014. It was a big deal to break those. It's an even bigger deal to have rallied back on top of it. And if we close where we are by next week, this will be a key reversal on the monthly chart on soybeans. That's not to be discounted. That's a big deal, especially if you can get some follow through off of it to the upside. So again, as bearish as corn is, beans can be equally bullish, and those two things could offset. So so we just want to stay nimble, and I highly recommend hedges be in place. It's a perfect opportunity to buy puts. And if you're tight capital and need help getting puts in, I highly recommend moving into a managed pricing program where somebody else floats that capital for you. We can do that for you through Indigo. We've been doing it for guys. It works very well. You just sign up to how many bushels you want to deliver. You choose your delivery point wherever you want it to be, and Indigo fronts your money for your hedges. And it doesn't cost. It only costs 5 cents a bushel. I'm sorry, it only costs 2 cents a bushel from Indigo's side to do that deal. So there are ways to manage your risk with low cost, or go talk to your banker and make sure he understands that corn has a dollar downside, and it would be in his best interest for him to be hedged. And that would be a very good use of 10, 15 cents a bushel to get that risk out the window. Last but not least, and I'll be really quick on wheat. Wheat's on a tear, kind of the same issue as cattle. The shelves are empty with bread. That's perceived to be big demand for wheat. That may or may not be the case. I don't know. It certainly makes sense that if people stop eating high meat rations, we're going to increase our carbohydrate ration to something else, and grains are a good place to go. So that makes sense to me that wheat could really get more legs here, as our acreage is at an all-time, or is at a 100-year low, and the world seems to be coming to us for that residual supply that it's been needed. So yes, this is overbought. Yes, it's a little bit overdone, but this could really start to get interesting here as well. So that's all I've got for you guys today. I'm really not trying to depress everybody on the corn side, but I want your eyes to be open to it too. I don't want you to think that just a 40-cent move is all that corn's got in it, because it could easily surprise us and go a lot farther than that. All right, with that, I hope you all have a terrific day, and we will talk to you later.